Ladies and gentlemen, please welcome your panel on private equity, a continuing evolution of capital access, moderated by Managing Director at Fitch Ratings, Mark O'Lean.
Mine works, yes.
Does it work? Yeah.
Okay, so we're going to do introductions. So rather than having him read it, my name is Glenn August. I'm founder, CEO of Oak Hill Advisors. We run almost $40 billion of capital in the credit space, from bank loans, high yield, stressed, distressed, direct lending in US and Europe. I've been doing this for 33 years this August, and it's nice to be here. Thanks.
Hello, my name is Nazim Azimbayev. I represent NSC MBK, which is Sovereign Wealth Fund of Kazakhstan. We're a relatively young sovereign wealth fund, and we actually manage part of our international reserves. We started back in 2011, and I would say that our focus on alternatives gave us kind of, like a lot of benefits for the past decade.
Great, my name's Maggie Finari. I'm with the Ontario Teachers Pension Plan and lead our investing strategies for both public markets as well as tech.
My name's Ray Thorne. I lead Two Sigma's private investment business known as Sightway Capital. Two Sigma was formed about 20 years ago to find value in the world's data. We do that across a number of activities, the largest of which is investment management in public markets. We started our private investment business about 10 years ago. And we're a little different than most private equity firms. We focus on building new companies in asset-intensive industries like real assets and financials. And then we try to grow those companies in size and scale to large enterprises and try to harness the power of Two Sigma and decision science to enhance the outcomes where we can.
Andrew Weinberg, founder and CEO of Brightstar Capital Partners, middle market private equity in the US, focused on being an operationally value-added partner to families, founders, and entrepreneurs.
This one. Hi, I'm Mark O'Lean. I'm Global Head of Business Development for Fitch Ratings, based in Chicago. Hopefully you all know what Fitch does. If you don't, obviously I'm not doing my job too well. But I thought maybe we'll start at the other end of the table there with Andrew. Historically, if you go back, the industry has sort of targeted 18 to 20% returns. Now with all the money coming into this sector, the asset class, and the declining yields, is that still realistic, and is that what you're marketing to your clients?
Sure. At Brightstar Capital Partners, we're a bit traditional. So we still actually target 25% or more gross returns, which net to 20% or more for our investors. We do that because we're highly selective in what we invest in, which is traditionally about 2 platforms per year, as opposed to some of our peers who are, let's say, spread across more portfolio companies. We still see great opportunities, especially being the first institutional capital in family-owned businesses, as opposed to buying from other sponsors. So we're going to stick with that target threshold. We're achieving it, and we see great opportunities in the U.S.
Sure. So we don't talk about our target returns specifically, but I would say the industry is, generally speaking, targeting similar to returns as it has targeted in the past. The truth is, I think that there's, at least our belief, is that there's quite a bit of equity beta, embedded in private equity returns. And what I mean by equity beta is a return that's driven by the equity markets and valuations in the equity markets. So what we do is try to focus on opportunities where there isn't as much equity beta. We focus on building new businesses with assets at their core that generate income that oftentimes have credit risk associated with them, where that income drives a good portion of our return. And hopefully we can, a portion of our return be based on the franchise value of that business at some point in the future. So as the market's gotten increasingly competitive, as multiples and valuations have been at very high levels, we've tried to look to a different strategy and tactic to try to find private equity style returns.
Okay. And Maggie, as you're looking to allocate your investment funds across private equity portfolios, what is the range of returns that you're hearing about and the ranges of products that you're looking at?
So we really think about them in terms of risk-adjusted returns. So for more traditional private equity businesses, we're still targeting 20%. And then if we're looking at technology and venture investments, those will go high as 4 to 5x. We're able to find these opportunities. By and large, we're trying to focus on partners, creating proprietary off-market transactions for ourselves, and really working with partners we've worked in various regions with over the last 20 years. And we're also expanding quite aggressively outside of North America. We're expanding our offices and the types of investment opportunities that we're looking at in Asia as well as in Europe.
Okay. And have the returns that you've experienced actually matched up with the expectations?
Yes.
And how does it compare to other asset classes?
Yep.
Okay. And Nazim, maybe you can answer the same question. If you look across your private equity investments, how they perform versus other alternatives versus expectations?
Yeah, actually, I think that when we started a decade ago, it was kind of a really attractive asset class, and we still think that it is. However, I think that in terms of returns expectation, we don't expect the same kind of, like results that we've seen the past decade. And what we are targeting, it really depends on a strategy. We do still expect 20%. However, I think that for GPs, that could be, like really challenging time. For growth equity space where we are more positive in terms of expectation, I think that we might see it in next 10 or 15 years.
Okay. Glenn, as we
Yeah,
look
if I can just comment, it's great that the people on the panel all are targeting 20%, but the reality is that the last decade, private equity has averaged about 11-12% net. And that's with a stock market that's tripled. And so the issue here in private equity, from my perspective, and I run a large credit business that finances many of these private equity deals, is that there is massive dispersion in private equity managers. So there are, in fact, some private equity managers, and I'm sure all of the four on this panel, who are generating 20+% returns. But the reality is that the median is 11 to 12 during one of the best equity markets of all time. And so the question really is, what is the expected return going forward if the equity market, the public equity market, doesn't deliver high single digits or double-digit returns? And I would put forward that they're lower. Now, that all being said, because we have lots of institutional capital from many people who give us capital and credit, but also have substantial allocations in private equity, my personal belief is that the best managers, and not even just the top quartile, but the top 50%, can in fact generate double-digit returns. I might have some pause on whether or not they'll be 20 and whether or not it might be closer to 12, 15 on a net basis for that top group. In so much of the world, and even in the US with a 160 10-year, that if you can generate double-digit returns, it makes sense. Without being too self-serving in terms of the strategies that we work on, our view is that there are segments in the credit market where you can get double-digit returns too and take meaningfully less risk than equity. So our view is that private credit in particular represents attractive relative value. But certainly, private equity has a very important place in portfolios. I personally believe there'll be substantially more capital allocated to private equity because the expectations in public markets in equities or in public fixed income in risk-free assets is so low that most investors need to enhance their portfolios.
Just picking up on a point that Glenn made, I completely agree that the median return is in that low double-digit range. But if you do look at asset categories you can allocate to, it is actually the highest median return, but does have the widest dispersion of any asset category that you can potentially allocate to. And so manager selection and strategy selection, is key to driving returns across the portfolio.
Totally agree.
And I think the two of you at the end invest a lot in some of the smaller companies, right? Historically, the industry would focus on buying mature companies, right? And now it looks like there's a much wider range of possible investments, taking minority stakes and getting much earlier stage that way. Is that the case, or where do you find growth?
Yeah, so at Brightstar Capital Partners, we tend to focus, I'd say, on some of the forgotten companies. And we're going to call those roughly the 200,000 companies in the U.S. with revenues more than 10 million, but less than 1 billion. By order of magnitude, there's about 9,000 companies owned by private equity in the U.S. And as you'll see in the data, about 3,500 public companies. That used to be about 10,000 or so 20 years ago. When we approached the market, which we've been doing for 20 years, to work with these families, founders, and entrepreneurs, it came across very clearly they're looking for more than capital. Capital is completely commoditized at this point in time. So what else does someone bring to the table? What we brought to the table is operational know-how from both our investing and our operating backgrounds. And bringing that to companies where we're the first institutional capital tends to be a fairly welcome reception about how to actually grow the company more than it might grow on its own. So we see actually the market opportunity very significant. It's about a $30 trillion wealth transfer that will occur in the next 30 years. Children have children, and 3 to 4 generations later, there tend to be 9 to 27 shareholders in what is frankly an illiquid private company. So we love the challenge ahead of us, aside from other thematics we'll talk about during this time, but that wealth transfer in those private companies.
And Ray, are you also moving into earlier stage companies?
Sure. Well, certainly. First of all, we don't generally buy existing businesses. We try to find an opportunity in an area that we think is a strong risk reward, and we'll build a new company with an executive or an executive team in that space. We generally don't like to pay others goodwill. We like to try to build goodwill and sell it to others over time. We also focus. So that's the first point. Second point is we also focus on asset-heavy businesses. So most of the private equity universe actually will focus on asset-light companies. We try to focus on businesses where there's a balance sheet, where there's assets that generate income, that comprises the majority of your return profile. And that income and those assets provide downside protection and volatility mitigation during across a cycle. And then the third thing is, in terms of how we build value in our companies, is we try to bring Two Sigma's expertise in data science and the technology that supports it to our businesses to try to help them make better decisions, more automated decisions, embedded in the decisions that they're making, to try to hopefully be more predictive in the decisions that they're making, whether that's around customers or around asset underwriting or some key elements of their businesses. We're trying to bring with data scientists and engineers, bring those capabilities into our companies as much as possible.
Okay. And this is something I'd like to ask of everybody, but maybe starting with Maggie. In terms of investment themes, infrastructure, healthcare, food security, cybersecurity, climate change, are there particular sectors that you'd like to put money to work in over the next couple of years, or specific opportunities, regional or sector?
No, not necessarily. I mean, we've got a number of sectors that we do cover, which creates a very perspective from us. So some of the sectors and themes you suggested are those that we focus on, but we're really much more focused on finding the right partners and the right opportunities. But where we are transitioning some of our capital is into late-stage venture and growth, which is an investment strategy that we've launched about a year ago. And really they're supporting founders and entrepreneurs as a minority investor over time and helping them to grow their businesses. So we're looking at alternative products. We're also looking to be minority investors in pre-IPO situations with families and generational change, which you often see in Europe. And really those are companies that are looking to go public and efficiently managed, and looking for institutional shareholders that are able to be there for them both as a private shareholder and then continuing to hold on through the public markets as a long-term shareholder. And we're finding that that's creating opportunities for us globally, and particularly in Europe.
Nazim, how about you?
Yeah, actually, I would say that in terms of partnership, it's becoming really essential now to have a really long-term strategic partnership, because I think that being a long-term investor, it is really difficult not to take into account the potential technological disruption that we might experience in the future. And it means that so we spend a lot of time trying to understand what would be kind of the best asset allocation and how to capture some areas that we think would be really kind of, like performance driven in the future. And I think that technological edge is something that is our focus now. And we see that the impact of that is going like everywhere. And actually climate change as well. And I think that these two topics are really important, and technology will help to understand what would be kind of exact impact on the economy. So that's why in terms of the selection process, we try to find strategic partners. We see a lot of potential in technology, and I think that the technology will be everywhere. So that's why it means that we have to build the portfolio which would be kind of really good in a case of disruptions in different areas. And actually, I think that it is a challenge for infrastructure investments, where we know that it is kind of a really long-term projection on different areas, and this area could be disrupted easily. And we've seen some cases, and we have to be cautious about that.
How about in terms of
Geographies, we try to be global because we think that diversification is really important. In terms of the vision, I think that China is becoming really attractive these days, but the best way how to enter the market is still really challenging. So that's why when we started mostly from North America and Europe. We have some allocation to Asia as well, and we're planning to have the best way to increase our China allocation, because we see a lot of kind of technological achievements that China actually has now, and I think that it will grow in the future.
And Glenn, where are you looking to put money to work?
So in performing credit, you can make 5 points above your points. So the real key in credit is avoiding mistakes. And so the entirety of what we do is all about company selection and industry selection too. Last year, there were 132 different large leverage loans that went down 10 points. We own 5 of them, representing less than 0.14% of our portfolio. And so the real key is trying to avoid certain companies because they've got the disappointing management, that you don't have confidence in terms of some of this ESG on the governance side. We avoid cyclicals in terms of the commodities because you can't control commodity pricing. In our distressed business, we focus on where there's opportunity to turn around a business. We have a very large, over the years, over almost 14 billion of distressed investing. And in those situations, you're trying to, where you can make substantially more than 5 points, you could make double, triple your money. We're really looking at opportunities that are misunderstood by the market, whether or not there's a short-term blip from a performing standpoint or some assets that have been disappointing. And so it's all about company selection. We focus on recession-resistant businesses. The world has changed a lot over the last few years in terms of the types of deals that are getting done in private equity, with more focus on some of these growth opportunities. And so you're trying to understand capital intensity. We run our firm like a private equity business with industry line, and we cover companies. And I said, when I took over the credit business back in '90, I came up with a very simple line: we buy companies, not securities. And so it's very much a private equity mentality to credit.
Good. Well, I was hoping you weren't going to say your biggest opportunity has been loan to own.
Well, there are some opportunities, but mostly in Europe. We can cover that later.
Okay, great. Maggie, already we've heard a couple of times here, ESG. Obviously, when we go out and visit investors, it is the hottest topic out there. How has your process changed over the past 18 months, and what are you telling your managers with regards to your process in ESG?
I mean, our process has incorporated ESG, but we at the end of the day, it's part of our process, but it doesn't drive our process.
Glenn, how about you? I imagine you're hearing it from your investors
We
daily.
certainly hear it from our investors, although I will tell you that from time to time you hear investors saying we care more about your returns than your ESG compliance. But we have tried to be ahead of this. We have, I think, a 12-person committee internally. We've used outside consultants to build a real durable ESG program. We score across all the different elements of ESG, each company that we look at. And I will tell you, I do believe it is a good business too. And again, when coal is one that everyone comes to, and we have not played in coal because some of these sectors, again, are under secular issues as well, besides being environmental. But there's a lot of companies that we look at that don't match up to what we want to do and what our investors want to do, and it does cover the gamut. I do think that from an investor standpoint, from how we manage our firm, it's very, very important.
Okay. Andrew?
So ESG, the data's clear. If you have principles around ESG and you follow them, you'll perform better than ones that don't. I go back to my business school days. One of my classmates started an ESG consulting practice, and for about 15 years, no one showed up. And then all of a sudden, the world changed, and all of a sudden, he was more full of clients than he ever thought he was going to be, and advantage as a firm. For example, we own a water producer, a municipal water producer in the state of Texas, that uses very sustainable practices to deploy water, so retail water utilities have water to fill the homes, swimming pools, et cetera. And by starting with ESG as a core principle in this company, we've been able to partner with regulators, with municipalities and others about how to use this to expand the scope of the company. I'll take it one step further. We recently partnered with a pioneer in diversity, equity, and inclusion, Billie Jean King, and her consulting firm to start bringing the best practices of how to make sure the companies that we have, and again, as an industry in the U.S., about 7 of the 10 largest employers in the U.S. are private equity firms when you aggregate the scale of the portfolio companies. I know today we don't represent a full cross-section of society, but our goal is to do that. So we marry up ESG as well as diversity, equity, inclusion, DEI. We think we can be pioneers in the industry, and as a sector, really bring best practices to other companies.
I'm curious, this is for anybody. Read something interesting a while back about CalPERS that was rethinking their investment philosophy dollars they felt they had lost in returns. Do you ever have investors coming to you saying, I don't care about ESG, or find me opportunities that, that are not related to that don't incorporate that? No?
Again, we've had a couple of investors who have said it's not a primary focus, but by and large, like CalPERS, we get most investors who will, in fact, opt out of certain segments that might not even be ESG, but meet their company's guidelines, their investors' guidelines.
Okay.
I think that ESG has always been important to us from day one, but I think when one of the things I don't like about the term ESG is it implies something external to the investment activity that you're doing today. And I've always thought of, especially with the type of investing that we're doing around business building, that an important element of the S is people and human talent, and we're investing in every business into people that are driving that business forward, whether it's from the senior leaders of that business all the way down to the entry-level employees. And so I think about the investment side, but rather being a framework of how you do business in a positive way, which is also good for all of the stakeholders of the companies that we're investing in. So there are other elements of ESG, such as the exclusionary element, not investing in tobacco, in stocks, if you will. But I tend to think of ESG as being more a positive way of doing business that we would like all of our companies to adopt.
Okay. Let's talk about some other risks. Nazim, are there sectors that you're staying away from due to some of the things that you mentioned, either disruption or other reasons, technology?
Do you mean like secondaries as an asset class, or?
Yes.
We do like secondaries, yeah, and in terms of like the disruption, I think that the effect of disruption on the secondaries as an asset class, I think that it's not so huge, and I think that secondaries could be kind of the next driver of the whole probably private equity industry, because it's becoming more efficient. Will give kind of additional edge in terms of analysis to the area.
Glenn, are there areas that you're staying away from specifically?
Well, look, again, I think this whole issue of disruption in industries in secular decline, it's very difficult to make money. There are certainly the exceptions, but if one looks at the retail industry that has been so transformed, first it was Walmart 25 years ago in terms of its mass proliferation across the U.S. and around the world, and that whole discounting. And today, obviously, it's Amazon, and that will continue to change. So we have found that those sectors that have secular decline are very challenging, and we do choose to avoid them.
In terms of data sciences, this is an area, obviously, everybody's focusing on data these days. And Andrew, in your credit process, how are you using or changed your process to incorporate this?
Sure. If we go back in time again, I think history teaches us a lot. I think we, in the past, had an industry that was fairly anecdotal, and all of a sudden the data started appearing and we could collect the data. Many years ago, time tends to get lost in anecdotal to actually what the data shows. At our firm, we invested significantly into our CRM system and other data analytics that feed into it about where the opportunities are. For our particular business, these family-owned businesses, where they're growing populations and more needs for these companies. What particular states might have tax regimes that are not favorable, let's say, to family-owned businesses for the one transaction they may have in their lifetime and the impact of that. So I still think we're early days in terms of data analytics and data science. We do actually own the largest private company that's maintaining and deploying 5G Qualtech. With the flip of the switch and when 5G is turned on, we think the combination of AI, digital twins, and others is going to really enable a lot more critical thinking and use of data to drive decisioning, and we're looking forward to that switch being flipped in the next couple of years.
Sure. In my view, data is really changing the private investment landscape. It has become, over the last several years, incredibly prolific. If you think about your phone following you around everywhere you go, your credit cards processing every transaction that you're making and every item you're purchasing, your television telling in the world about what we do, both as consumers as well as businesses, that using that data, which is available, alternative data sets become available to help make decisions inside our companies, as well as where to focus in our investment process, is changing the way that our business works. And so we're endeavoring to build a team that has a combination of traditional investment professionals, technical professionals that are experts in data science and engineering, and then finance and operations professionals. I think that's what the private investment firm of the future looks like, and we're hopeful to, in our case in particular, borrow off of capitalize on the 20 years of history that Two Sigma has using data to invest in large liquid markets in that regard.
Okay. Meg, I wanted to give you a chance also to comment on areas that you think are either ripe for disruption or areas that you're just completely staying away from.
Yeah, I mean, I think from our perspective, there's a real opportunity to be investing in disruption, which also creates, in many ways, a hedge for the assets that we do own today. And as people on the panel have said, it also creates knowledge and data sharing for the assets in a nice virtuous circle. So we're really looking for new areas to be investing in disruption. So whether that's in digital healthcare, whether that's climate, I mean, there are lots of areas where we are looking, which we have not traditionally done, but more so in the disruptive space. Right. But again, given the expertise we have within the fund from a sector perspective, that gives us a broad landscape to be looking both at a number of themes as well as globally.
Okay. Yeah, certainly after ESG, that seems disruption, certainly the most common theme that we hear in our tours as investors. We had an interesting couple of comments a couple of months back where we had, within the same week, we had an investor in Europe ask us how Google was going to disrupt the electric utility industry, and then another investor in the U.S. asking how Google was going to disrupt the insurance industry. Fascinating. Nazim, you probably heard that we're having an election here in the U.S. In terms of political risk,
Yeah, actually, I think that U.S.-China relationship is the big topic now, and probably we are at the beginning of kind of, of the evolution of relationship between two largest economies in the world. And we also see a lot of noise regarding Brexit, and I think that elections, would be kind of really interesting event as well. And probably we are talking a lot about disruption, and we remember that last time, actually, it was kind of a really impact from social media, and actually they used a lot of data science techniques to actually predict kind of a behavior of people. And I think that, this year we'll probably see something the same in US. We've seen some not probably successful cases in Iowa, for instance. But I think that the largest topic would be US-China, because I think that it could slow the global economy growth, because escalation of the largest economy was the growth.
Okay. And Glenn, without asking you to get too specific, are there, given the elections upcoming, are there areas that you're steering clear of until there's better clarity over who the candidates are?
So obviously in the U.S. elections, there's a very stark choice. There's stark choices on the Democratic side, and we'll talk about this. I guess we'll hear more about it from more informed people this evening. But obviously there's a very liberal, left-wing, socialist movement in 40+ % of the U.S. Democratic Party. And then there's a moderate side which doesn't seem to have a leader that people are coalescing around. So there's certainly a lot of fear that the Democrats choose a very left-leaning candidate. If that candidate were to win, that would have real impact, and it could ripple through lots of industries, certainly besides corporate taxes, healthcare. Industry would be transformed. There could be some positive opportunity. And again, a lot of people are suggesting that it's easy to discount the left side of the U.S. political system. But Trump's victory was somewhat of a surprise too, and so you can't be overconfident on that side. But I would just make the comment a bit broader and add to the comment on geopolitical risk is really, in many respects, the biggest risk out there today. Leaving aside, but there is, with rates, global rates so low, and a very supportive Fed and central banks, the economies around the world generally in okay shape. China becomes a very significant factor. I like to say that the Fed saved the world and the central bank saved the world after the global financial crisis, but really China took the world out of recession. We saw in 2016 when China showed some signs of weakness. Its impact was extraordinary, and we'll see how this plays out right now. And so I do think you need to process geopolitical risks when you make investment decisions, but that just circles back to my earlier comment, which is you've got to pick good companies. And it's not about 1 quarter or 2 quarters, even in credit. Certainly in private equity, you need to have a longer-term perspective, and you need to move with the geopolitical, move with the industry's factors that are going on.
Okay. Sounds like everything's great. You get 25% returns in public equity or private equity. You get 18%, 14% double digit, right? You had all the risks on the table. You had a number of elections in Europe. You had Brexit. You had trade policy in the U.S., economic policy. You also had rates theoretically going up to 350 or 300. So now I don't think anybody's projecting anything like that in terms of rates going up. We have pretty good growth in the U.S., pretty good employment growth as well. Let's go down the list. Andrew, where are the risks here?
I always think the risk is the unexpected. The word exists in the dictionary for a reason. We look at the environments that our businesses play in, which tend to be above GDP growers, but specific risks, and let's talk about them. You mentioned the rate environment. By any historical standard, whether a year ago or now, we have a very low rate environment, and clearly the world in general has depressed rates to kind of at or even below zero, depending what country you live in. Unemployment, lowest rate in 50 years. If you want a job and you're skilled and trained to do it, you'll have a job. That theme, though, is a challenging one, which is as the economy continues to evolve and digital value creation should represent about 70% of the value created going forward just from digital platforms. We're seeing that the workforce may not be. For companies, we've actually put in the budgets additional expense for training to make sure that our workforce is prepared not just for today but for tomorrow. In terms of other signs out there, we may be late in the cycle. We're not sure. There are clearly other more qualified people at the conference to be able to talk about that dynamic. But we continue to see great opportunities in the United States against a great backdrop of, again, entrepreneurs and businesses with very little in the way of success.
Okay, Ray?
Well, I think a couple areas of risk that Glenn spoke to are around policy. I think we rarely, and I'm trying to think back to a time in my investing career where you've had, as an investor, to prepare for two very starkly different potential policy outcomes, and that it can have a meaningful. At least I'm a believer that policy can have a meaningful impact on outcomes. And so that's we haven't seen yet, and don't even today see signs of, but I think is potentially underlying is inflation risk. We've had very benign price inflation. We certainly had quite a bit of asset inflation, and I don't think the world is positioned well for meaningful price inflation. I haven't seen signs of it, but I think that would be something that would be a surprise to the investment world if it started to occur.
Okay, that's one I haven't heard in a little while. Maggie?
Yeah, I mean, very similar commentary, and I think as a result of that, we're just far more focused on the businesses that we're buying. We're trying to price in some of those risks. And then as a plan overall, we've got the ability to think through some derivatives and other instruments that we're able to use to manage some of those tail risks.
Okay. Nazim?
Yeah.
Nothing concerns you?
I think that there are many risks that we actually probably underestimate these days. And one of them is inflation. In a low yield environment, and in terms of inflation and unemployment, everything is pretty stable, especially in US. And when it changes, I think that it takes time for people, for investors to find kind of the best behavior and to change their portfolios, which could be challenging because when we see inflation, I think that it will be really high demand on selling some assets and buying probably others. And also, I think that probably we underestimate a case with the coronavirus, for instance. And in the future, we might have the situations which could be really similar to what we are seeing now. And we have to create kind of environment where we can handle it. And in terms of kind of procedures that we have now, we realize that we are not able to do really efficient measures to prevent just kind of viruses. And actually viruses, it is something that we have for many years, and we have stuff. But I mean, in terms of healthcare, we're not able to be as fast as we have to. And that could be a really challenge for the future. We spend a lot of time analyzing problems like cancer, and I think that it is really important. And one day we'll find a solution which could be really helpful there. But I think we have to spend a lot of time trying to handle little problems as well, which we think are little, but we see what is happening in China now. And I think that nobody expected that people will start to afraid viruses.
Right.
And we do, and we see a lot of measures that are not really helpful. And I think that there are many risks, and it is really difficult will appear. So
Okay. Glenn, what are your teams telling you?
So it's interesting you talk about viruses. I would just offer up the virus that you didn't talk about is cybersecurity viruses. And I think the cybersecurity issue is a real risk. The potential of the financial system having major data breaches, major crimes associated with that. The data, every day we all read about more data breaches, and I know that we get attempts at hacking our system on scores of them on a daily basis, and so I think that's a very big one. This morning on the first panel, they were talking about income inequality and populism. Again, Trump was a surprise to many, but that was a reflection of an underappreciation of a big part of the country in the U.S., and the vote on Brexit initially was a miscalculation. What's happened across Europe over the years in Italy and Greece, new elections in Ireland, there is a move that there's a bunch of people that are very fed up, for sake of better words, with this massive income inequality. And to the point that was made earlier, if dealt with in a effective way, and maybe it can be dealt with in a more measured way over time, then there will ultimately be a radical response to that. And that radical response, if it occurs, will be massive policy changes around the world. And that is really the biggest, again, there's a cyber side to me. Again, I'm not as concerned even as a credit person about near-term inflation or rates, although there's certainly risks that are out there. But to me, the risk that you could have a major policy change that we all did not expect, that really came from its source of income inequality, I think is a real issue.
And can you manage your investments to either one of those risks?
Look, I think that that is so much more of a macro side. Certainly, we spend time in healthcare and how populism could change, and certainly if you had a Medicare for all system adopted in the U.S., there would be major changes, and so I've certainly have charged my teams to focus on what might be the opportunities and where is their risk, and there's certainly been a number of large buyouts in the healthcare space that have significant regulatory exposure. When you charge one person who has insurance coverage $50,000 to pick you up if you have a disaster, you need a helicopter pickup, and another person who pays $5,000, that possibility of that collapsing is real. And so again, you really need to look through every business that you're in, try to understand where the risks are.
Okay. Now we've had a good run in the credit markets also. Let's turn a little bit to the debt side. Andrew, from your perspective, how do you ensure that if we are reaching a turn in the credit cycle, that your companies have access to liquidity? Sure. Are you managing that any differently?
Yeah, so I think, look, Glenn's obviously going to have some great comments on this, given his background in credit. From our perspective, there are two things that become really important to us. Number one is know who our partners are on the credit side. We spend a lot of time getting to know our partners. We don't call them lenders, we call them partners. And we think a lot about how they think about constructing their business. Things are tough. And by that, we actually build relationships that had sustained us in the prior downturn with very traditional banks that look to hold credit as opposed to syndicate or move credit. The second thing we've done very proactively across our entire portfolio is term out debt. We think duration, the combination of either duration as well as covenant light when applicable, will actually afford us the opportunity as equity owners to both go through the downturn and benefit. I will tell you, we talk about at our quarterly all-day investment committees how to benefit when the downturn occurs. And we'll be very proactive buyers of great companies at likely lower prices in the downturn, underpinned by strong balance sheets.
Okay. And Ray, have you seen any changes in bank behavior as we get to this point in the cycle in terms of availability of capital?
Well, the credit markets are certainly quite robust from both banks as well as non-bank credit providers. In our companies, we're quite conservative from a financing standpoint. We've only used or largely used asset-based financing in our companies. Asset-based financing is one of the more conservative, stable forms of financing. We try to use structured credit markets, and asset-backed terming out debt. We're using ABS markets to term out our financings and provide structures that are able to withstand several $1 billion, I believe, of asset-backed securitizations over the last several years, and continue to approach that market, quite robustly. The other thing I would say is that we, this is maybe harping on this theme, but we try to use as much data science as possible to understand the correlation of risks embedded inside of our portfolios. So, looking back over long periods of time, understanding how asset values change in different market environments, different economic environments, and modeling and simulating, those changes and those correlations will help us build, the most durable portfolios through different cycle environments. And so that's another area that we, look to try to shore up our financing structures as much as possible.
Okay. In terms of, Glenn, in leveraging the system, you think back to the financial crisis, obviously we had our old friends, the CIVs, we had synthetic CDOs, CO squared, all of that. First of all, do you think that's true, that there isn't that kind of leverage in the financial system due to regulation and some other factors?
So I want to make a couple comments. The answer is there's much less leverage in the system today, and it's better structured in general. I wonder if I may just make a quick follow-on comment there, and I'll come back. Talks about, are we at the end of the credit cycle? As if that is A, imminent, and B, that it's solely focused on credit. So let's just be clear that when there is the end of the credit cycle, it means that the public equity markets and the private equity portfolios that people invest in are going to get hit probably more than the credit investments. Okay, if you look back to 2008, if you look back at every distress cycle, when credit went through the quote-unquote end of the cycle, it hit the public equity and the private equity portfolios. Now, again, for all of us who have availability of capital, there's also great buying opportunity, but we shouldn't just say it is the end of the credit cycle and not think it doesn't affect public equities and private equities. So that's the thing. Second thing is availability of credit. The two things in credit from a private equity perspective are ultimately availability and pricing/terms. The fact is, for private equity today, there is, generally speaking, very free availability. The U.S. banking system is in the best shape ever. The institutional environment, institutional investor base that I'm a part of and my colleagues are a part of is very vibrant. And the reason for that is in a very low-rate world where fixed income, risk-free fixed income is trading at less than 2%, everyone in the world is looking for yield. And so there's a lot of money that is coming in, and if it's deployed, not as good as you got last year, but they're available. Wearing a private equity hat on, the key, if I were running a private equity portfolio, would be to have very long-dated maturities, so I have that flexibility, pay up a little bit to get better terms, longer-dated maturities, fewer covenants to give you the flexibility to ride through a downturn. But again, there's this intertwined nature of public equity and the private equity and the credit markets, and so to me, you have to look at this holistically and then from each side of the equation. And then with regard to the amount of debt in the system, one of the areas that has been a big part of the growth in credit has been structured. Two big areas. One has been the CLO market, which is collateralized loan obligations, which has become a giant business. And today, finances about 65% of all buyouts. 65%. So again, in terms of risks in the system, if the AAA buyers, who mostly are based in Japan, and a few others around the world decided they wanted to boycott or they were getting regulatory pressure. There was a point last year where the Japanese were putting pressure on some of the largest CLO providers of AAA financing, which is actually quite good risk-adjusted return in our view. That can dislocate. That has a ripple through into the market. And so again, my view is worked. People could lose money, but at the end of the day, those structures work. And I don't see systemic risk in the system from leverage.
Yes, certainly the CLO structure, it's about once a month you see an article that's always alarmist in nature talking about CLOs, here we go again. But if you look back at actually how they performed in the last cycle, they performed as designed, even when loans were down.
Right, but there's massive, to be clear, in 2016 when energy prices went down materially, there were a number of CLOs that had substantial energy exposure. And just like private equity dispersion of returns, there was massive dispersion in certain CLOs. And so that's, again, a great opportunity to try and seize on that as well.
Right. Meg, on the fixed income market, are you concerned here we have still very low default rates, although ticking up a little bit? Potential, this cycle has obviously been very long. Have you changed how you look at the fixed income market at all?
So my focus is on venture growth and public markets, so probably not the best person to speak to on the fixed income side.
Okay. Nazim?
I'll leave it to Glenn or Nazim.
Yeah, on a fixed income side, I think that analyze kind of an impact. However, our focus on equity side more. So that's why I think that we'll see some changes here, but I think that it really depends on a focus. So we think that asset classes that we have now will be beneficial for us in the future.
So you can, forgive me, you can have defaults if you don't have any debt maturing. So there is not a lot of debt that's maturing over the next 2-3 years.
Right.
So the only place where you can have defaults is where there's massive dislocation, and those places are basically in the energy market, which there's lots of exposure when oil prices go down 20% in a month, or they've gone down 50% over the last number of years, 40-50%. And so there's a couple sectors where there's risk of default, but with very few maturities, with very few covenants, there's really not a risk of default. So again, it goes back to the dislocation, disruption. Doesn't mean debt prices can't go lower, but you're not likely to have a big default cycle imminently.
I'd also add, I believe there still remains significant opportunity in the non-bank lending market, particularly in Europe, but also in some areas of the U.S. We recently started a business in the healthcare finance arena focused on equipment leasing. It's a segment that's largely been consolidated by banks, and yet it's yet the bank credit box is extremely tight. It's not being served by by banks. In Europe, we recently started a business that's focused on commercial real estate lending that for lower middle market properties that are greater than 1 debt service coverage ratio, loan to values in the 60 to 75% range, and for some reason, though, the properties fall outside of the local or regional bank credit box. And so I think there's there's a significant opportunity, particularly in some geographies, but in other niches inside of more mainstream geographies to build businesses that capitalize on the continued dislocation in the banking space.
Okay. Yeah, and there's been an absolute multitude of different financing vehicles that have thrown money at the leveraged loan space. You've got BDCs, you've got unitranche, you've got middle market CLOs, direct lending, you've got all sorts of things. Maybe, Glenn, since this is in your team's wheelhouse, what do you look for first?
So just real quick here, since we're running out of time, the private, I agree entirely that there are niches in credit where they're underserved. Where we're finding the most attractive value today, interestingly, is large cap corporate private credit, because the leverage finance market built up their own capital markets groups. Large firms like ourselves have tens of billions, if not hundreds of billions of capital. The banks are basically not taking any risk. They want to syndicate out. And just like Andrew said earlier, if you can be a partner, and by the way, we talk about being partners with the companies that we lend money to, then you can build a really good relationship and customize a capital structure. So we think it's scalable. We think the value proposition is there when private equity is paying 10, 11, 12, 13, 14 times. If you can be lending at 50% loan to value and still making double-digit returns in size, in scale, in good businesses, we think that's an incredible opportunity. So that's where we see is where a lot of our focus is.
Okay. And it was interesting, I think it was last week that the Fed came out and said in their next bank stress test, they're going to focus on leverage loans in the system. We have about 1 minute left. So I don't know if we have any questions for the panel. Anybody? No?
I think everyone's saying they're hungry for lunch.
Yeah. That's right. Okay, well, very good. I want to thank the panel. Thank you very much, everybody. And thank you for attending.